Everyone, welcome to our autumn 2025 budget seminar. Our last one before Christmas, so to forget at the end, Merry Christmas to everyone. Hope you all have a nice Christmas. The budget was 15 days ago, and I think most of us probably thought it was quite a depressing watch. However, what sort of was speculated to be quite a seismic budget with talks about exit taxes, wealth taxes, and equalising capital gains tax with income tax. Actually ended up being a lot of tinkering with tax rises here and there, but no fundamental big shifts in tax policy. So when Adam and myself were tasked with coming up with this presentation, we thought we would try to keep it upbeat and light-hearted and not have you all depressed on a Thursday morning. And if you are depressed after this, then Manchester Airport's only a short trip away if you all want to flee the country. So the agenda for today, we're going to have a quick 10 minutes of just running through the main changes of what was announced in the budget, quick budget recap, and then Adam's going to spend 25 minutes talking about what we think was interesting and what the opportunities are for when you're talking to clients. So Adam's going to cover personal taxes, profit extraction, salary sacrifice, and some changes to BPR allowances. And then I'm going to deal with some specific points on capital allowances, landlords, EMI changes, and reconstruction relief. So that's the agenda for today. Both Adam and I are senior tax consultants at Forbes Dawson, but we'll jump onto the budget recap. So what we've done here is set out the four main changes that were announced in the budget. Now these first 5 points we're going to speak about in more detail later on, but I just wanted to include them so you've got a full menu to refer back to in the future. The one point that I did want to speak about though at the bottom is the changes to the temporary non-resident rules. Now, if anyone that doesn't know, these are rules that basically meant where you left the UK temporarily and extracted income or capital gains and returned within the UK. Previously, you were subject to a re-entry charge on your return if you return within 6 years. Previously, there was an exemption for post-departure trade profits. So where you had a company that might have had very little in the way of accumulated reserves at the point of exit, but then maybe sold a subsidiary and suddenly had large reserves, you could return normally, you could extract that as dividends and return into the UK within 6 years, not be subject to these rules. Going forwards, these rules are going to mean that post-departure profits that have been extracted as dividends will be caught by these rules. So if you've got clients that have left the UK recently, it's just a small point to be aware about. The other changes include changes to the ISA limits. So as speculated, the cash ISAs limits were reduced from £20,000 to £12,000 per annum. You still have the £20,000 annual allowance for stocks and shares and cash ISAs. How this is going to work in practice, there's a little bit of ironing out in detail to be looked at. It's not that clear where you've got stocks and share portfolios that hold cash, and maybe you've sold shares, or maybe you've got some funds invested in bonds, money market funds, things that are equivalent of cash and easily accessible. It's not clear how that's going to be impacted by these limits. There is some speculation that the government are going to try and stop people holding cash in stocks and shared ISAs, but how that will work in practice, it'll be difficult to assess. It's also, we speak about this 20,000 and 12,000 limits as if it's a maximum pot, but it's an annual allowance. So how it will work over time and interact with old ISAs, it'll be interesting to see how that happens. Cash ISA limits for over 65s are unchanged, and you can still hold £20,000 in cash. You can still put £20,000 in cash into your ISA on an annual basis. The closest thing that we got to a wealth tax in the budget was this introduction of this new mansion tax from April 2028. So this is an annual charge of between £2,500 and £7,500 for properties that are worth more than £2 million. So this is on top of the council tax that those properties will already be paying. Now, interestingly, these taxes are going to be assessed based on April 2026 valuations, unlike council tax, which are based on 1991 valuations. There's going to be a large exercise over this next 2 years on working out what these properties are worth. So I expect that there will be quite a lot of appeals and disputes around what these properties are worth, and people trying to get their property under into lower bands. That's what I expect to see over the coming couple of years. A lot of these properties, they're not like new build houses where it's quite easy to work out the value because there's 20 houses in a row that all look the same. There'll be unique luxury properties, so it's a hard thing to value for the HMRC. Interestingly, the OBR leaked prior to the budget that they thought that actually they weren't sure how much income this tax will raise going forward, because it's likely to impact people's decisions on selling houses, on capital gains and buying new houses for stamp duty purposes. So what they think they might collect in this tax might be offset by losses in market activity being reduced. Employee ownership trust, just a small point. So this is a relief previously where you got 100% relief on disposals to an employee ownership trust of a trading company when you held a controlling interest. From the budget day, this relief's been reduced from 100% to 50%. So going forward, if you're considering these structures, you're going to have an effective 12% tax rate on the structures. Final main change that was announced in the budget was this introduction to this new electric car pay per mile road tax. So this is on top of what was announced last year in terms of the EVs were going to be subject to road tax going forwards, and also the changes in terms of the previous exemption on the luxury car supplement. So going back from 2 years to where we are now, this is quite a substantial tax pay that the HMRC are going to be looking at on EVs and hybrids. So the rates have been set at 3p per mile for electric cars and 1.5p per mile for hybrids. As an example, I got an EV. I do about 18,000 miles a year. A lot of that's commuting to work. So I think my sort of additional tax charge is going to be about £500 an annum. So it's quite a big shift. How this will interact with the government's green agenda and going neutral, we'll have to wait and see whether it's going to reduce demand going forward. Don't know. Whether this is going to lead to a more fundamental shift in road tax to everyone paying a pay per mile system, could be a possibility in the future. So that's the main changes that have been announced in the budget. I'm now going to pass you over to Adam, who's going to deal with some specific points that we think will be relevant when you're discussing things with clients and others.
Thanks. So, as Michael said, I'm going to recap on personal tax changes that were announced in the budget, where we are now and how we've got here, and how that's going to sort of shape people's sort of remuneration planning and profit extraction strategies. And then we're going to just look briefly at the sort of IHT changes before passing that to Michael. So, where are we with personal tax at the moment? I think it was probably expected that we've got a continued freeze to the income tax allowances and personal tax and tax thresholds. That freeze has been in place since 2021, I think, and it's been going to be extended to 2031. So by that point, our personal allowances will have been frozen for 10 years. We've obviously had quite high levels of inflation over the last few years, which has sort of supercharged the effect of fiscal drag, which is the sort of process by which, just through having inflationary pay rises, people are dragged into paying higher rates of tax, even though their sort of income in real terms isn't increasing. What was announced as well, further increases to dividend tax rate from April 26. So we're seeing the basic and higher rates of dividend tax increase by 2%. That's obviously on the back of a 1.25% increase about 4 years ago now. And obviously in that time as well, we've seen our dividend allowance getting cut from £5,000 down to £500. So that's just an overall picture of dividends becoming more expensive method of extraction of profits from a company. And also we're seeing increases to savings and property income tax rates from April 27. So that's an additional 2% on the basic higher and an additional rate there. So I guess what we're seeing is an increasing picture of complexity. Instead of having, I think is it 6 different tax rates at the moment, we're going to have 9 different rates, because obviously there's going to be a different rate for savings and property versus other non-savings income. And then sort of alongside this, that was in the small print, the offset of the personal allowance is now going to have a specific ordering. So it's always going to be set against your sort of employment and pension income first, that sort of non-savings income, because obviously if your savings and property income getting taxed at a slightly higher rate, you would probably prefer to have used that against the income that's sort of subject to higher rates of tax. The budget didn't do anything to address any of the cliff edges that we've got in personal tax, so kind of much publicised. We've got this child benefit taper, so between 60 and 80,000, the sort of higher earner of a couple will lose, will have a clawback of child benefit where one of the couple claims child benefit. So that's an effective increase in a marginal rate of 6.7% between those between 60 and 80,000 for the first child, and then an additional 4.5% for every additional child. So you can be in this perverse situation where you have 10 children and have an effective tax rate of over 100% because of the loss of child benefit. I don't suggest having 10 children anyway, but it's not a good idea for income tax purposes either. We've obviously got the personal allowance taper as well, which most people know about. Once your income exceeds £100, you start losing your personal allowance by £1 for every £2 your income exceeds that level, until it's withdrawn in full at about 125,000. So that creates effectively a marginal income tax rate of 60% in that bracket. But the overall effective rate can be higher. If you're employed, you've got national insurance to think about as well, so that can be an additional 2% for an employee. If you're unfortunate enough to have a Plan 2 student loan, that's an additional 9% as well, so you can get up to 71% there. And then as well, for people with young children, there's nursery funded hours, which is a sheer cliff edge at £100. You earn £1 over 100,000 and you lose 30 hours of funded childcare a week. So that can be worth sort of £6,000 or £7,000 per year per child. So you have to earn quite a lot over 100,000 to kind of make you get back to where you were in terms of net pay. So all this kind of shows we've got a kind of a real complex picture that will sort of shape people's either profit extraction decisions or remuneration planning decisions, and it's not going to be kind of a one size fits all measure at all. So I've just put this table in just before we move on, just to kind of illustrate the effect of sort of fiscal drag on our allowances since 2020. So this kind of shows our personal allowances and sort of tax thresholds and the comparison if they've risen with CPI inflation over the last few years. We kind of forecasted figures for the last 2 years. So by the time we get to sort of 27, we should have expected our personal allowances to have been about 16,500, and maybe the higher rate threshold increased from sort of 37,700 up to about 50,000. If you just take those two numbers together, you might expect someone earning sort of 65,000 to still be a basic rate taxpayer had our allowances increased with inflation. Obviously, at that level, now they're going to be paying higher rate tax on probably 15 grand of income, so we're effectively 3 grand a year worse off in that situation, just because of that effect of the fiscal drag phenomenon. So let's look at the profit extraction picture and how business owners might look to remunerate themselves from their company. This table here just kind of shows the effective rate of extraction on every kind of additional pound of the basic higher additional rate bands. And I've sort of put the last couple of years, the next few years in there, just to sort of show how that's changed over time. So you'll see the salary got slightly more expensive, and that was just due to the employer national insurance increase from 13.8 to 15%, which came in at the start of the current tax year. But obviously before that, we did have some quite sizable cuts to employee national insurance. So at the basic rate, it was at 12%, and that got reduced down to 8%, I think, under the last Conservative government. And at the same time, dividend rate has obviously increased again, 1.25% a few years ago. It's increasing further from next year at the basic and higher rate. We've had increases to corporation tax as well, up to 25%, and cuts to our dividend allowance. So all that kind of creates a narrowing of the gap between the effective rate of extraction through dividends and salary. And we'll come on to an actual kind of worked example of how that looks on the next slide. What this does show though is if you have the opportunity to extract income by way of either interest charged on a director's loan account, for example, in credit, or rent on a property that the business uses, that is by far and away the best route for profit extraction, because you've only got one layer of tax because those costs are deductible in the company, and there's no kind of national insurance implications or anything, albeit those rates are ticking up in a couple of years' time by another 2%, but you can still see that at all levels they are quite a lot cheaper. And then just for kind of comparison purposes, unincorporated businesses as well, also offering a much cheaper route than dividends and salary. I suppose the interesting thing to look at with dividends and salary is at the basic rate, dividends are quite a lot better, but at the higher and additional rate, salary is marginally better. So you get to this tipping point, which I think Ben worked out is about £350,000, whereby if you're taking that much out of your business, you are actually better taking a salary at that level rather than taking it as dividends. So this is just a basic example of profit extraction of £100,000 out of a company. So in the first example, we've got salary up to the personal allowance, and then dividends on the rest, which is kind of the sort of the classic received wisdom for kind of extracting income out of a personal company. So we've got our salary, a bit of employer's national insurance on that, ignoring things like the employment allowance, and then the rest is going to be subject to corporation tax, assumed at 25%, leaving about £64,000 of dividends to take out. The take-home pay on that is about £63,500. Now, if we compare that position to if we're taking all salary, we'd be looking at a gross salary of about £87,500, and our take-home pay would be about £61,500. So you're about £2,000 worse off at that level by taking salary, which isn't a huge difference in the grand scheme of things. Now, if that same person is over state pension age, they are actually better taking salary, and they're better off by about £1,500, and the difference is the employee national insurance that they won't have to pay on that salary. And then again, just to reiterate the point, if you're a sole trader or an LLP member, you're quite a lot better off by operating under that structure. Obviously, the caveat being that you have no control really over the timing of your tax point, which obviously you do if you have a personal company. So, I guess to summarise on profit extraction, unincorporated businesses are looking even more attractive. I think there was a bit of concern before the budget that they were going to be bringing in some kind of equivalent to employers' national insurance on partnership profits and things. That obviously hasn't come to fruition. Interest rent is still the best option where you do have a company. Business owners, maybe do they want to consider dividends before April 26? So 2% on the basic and higher rate, but it's a consideration. Maybe consider taking any accrued interest on loan accounts before April 27. And then don't forget as well, pension contributions still very attractive, generally fully deductible for the company for corporation tax purposes. There's no increase in the income tax rate and extraction from pensions. You get your tax-free growth in the pension wrapper. We still have our 25% tax-free lump sum. How long that's going to stick around for is anyone's guess. But obviously remember, pensions are going to be brought into the scope of IHT from April 27. So if you're an employee, you've obviously got a lot less flexibility in terms of how you take your remuneration. But there are things that you can do, and I guess the key mechanism that most people have been using is salary sacrifice for pension contributions. So in the budget there was an announcement that from April 29 there's going to be a change for employees salary sacrificing their pension contributions, and only the first £2,000 of employee contributions under salary sacrifice arrangements is going to be exempt from national insurance or relief for national insurance. So currently, when someone sacrifices their salary for pension contribution, the employer has three choices. Obviously, they're saving the employer's national insurance because the individual is opting to take a lower salary in favour of that pension contribution. So the employer can keep the benefit of that NIC saving. They can pass the benefit on to the employee through net pay, or they can pass the benefit of that saving via an increased pension contribution. So from April 29, any kind of contributions made by employers, so we're talking that kind of like, contractual matching contributions and things, so not the portion that the employee has sacrificed, will continue to be free of national insurance. And these changes, they're probably not going to affect most people just paying in the basic minimum under auto enrolment. I think there's a marginal effect if you are getting the benefit of the employer saving to your pension, but if you take the benefit as either net pay or the employer keeps the benefit, then there should be no change for you. So this is kind of how it works at the moment if you are under auto enrolment. So there's pensionable earnings between, I think it's about 6.5 and broadly £50,000, and you have to make 8% contributions, which often is made up with a 3% employer contribution, 4% employee contribution, and then the additional percent relief is the tax relief claimed by the pension fund. So if you go to a salary sacrifice model, the employer makes the whole contribution and the employee doesn't make any kind of personal contribution, they just take a marginally lower salary instead. And then the additional benefit, which is the NIC saving for the employer, can either be paid into the pension, so that'll be an additional £600 into the pension, or if the employee decides to take that saving as net pay and the employer sort of passes it on, the effect is an additional £381 in the employee's net pay there. So moving on to how these new rules are going to look from April 29, where we've got a basic rate taxpayer sacrificing a portion of their salary. Pre-April 29 is this position here, where they take a lower salary, the employer makes a national insurance saving of about £750. The employee is obviously paying slightly less income tax and national insurance, albeit on a lower salary. So for the cost of about £3,500, the employee is getting a benefit of just shy of £6,000 into their pension. So post April 29, it's the same analysis, except the national insurance relief is only going to apply in the first 2,000. So here we have a reduction in the salary of 5,000. So the employer NIC will apply based on a salary of 48,000 in this example, basically. So the employer NIC saving is lower, the employee NIC saving is lower, the income tax saving is still the same. The overall effect being on £5,000 of salary sacrifice, 450 quid less in your pension and 240 quid less in your net pay. Same example for a higher rate payer, so on a salary of 80,000, the same £5,000 salary sacrifice. The cost of the pension is the same, because that comes from the employer NIC saving, but the actual net pay effect for the employee is only £60 instead of 240 in the last example, and that difference is basically just that at a higher rate you pay a lower rate of employee national insurance. So in summary, employees can still make pension contributions via salary sacrifice arrangements to reduce the interest in their income, and in a lot of cases it will still be very beneficial to do so. Keep below those certain thresholds like £100,000, preserve your personal allowance and things like that. And obviously you get your income tax saving as well, which is significant. The new rules are probably only likely to affect individuals making significant contributions over and above the normal auto enrolment levels. This isn't obviously going to come in until 2029, so we've got a little bit of time to sort of see how it's going to shape behaviour and what the practical impacts might be. But broadly, it looks like it's going to be more costly for basic than higher rate taxpayers due to the effect of that employee national insurance. There's going to be generally less flexibility for employees, I think. I know a lot of firms operate kind of bonus sacrifice schemes. I suspect we'll probably see fewer of those. And firms generally may move more towards an employer funded model with their kind of, they offer their kind of matching contributions and things like that, which may prove a better route, or we might see firms kind of moving away from kind of incentivising people with pensions and prioritising other kind of perks and employee benefits. We'll see how that plays out over the next few years. Just want to touch on the IHT changes in the budget as well. I think before the budget there was a lot of concern, certainly amongst our clients, about what was going to happen. I think a lot of people were feeling quite bruised from the last budget, and there was a kind of feeling of, oh God, what's going to happen now, sort of thing. And it was kind of a bit of an anticlimax for IHT, really. There wasn't really much in the way of IHT changes, and I guess that's potentially a good thing in the sense of, you know, things like there's not been an extension to the survivorship period for gifts, which people were worried about. They wanted to get a gift in before the budget, where they might only have a 7-year survivorship period instead of, say, a 10-year survivorship period. There's not been any change to regular gifts out of surplus income exemptions. We've got some clients that have got substantial pensions, you know, talking, you know, 6, 7, 8 million pounds. They're concerned about pensions being brought into the scope of inheritance tax. They're now saying, I'm going to start taking out my pension and making exempt regular gifts out of income. So that's being kept. There was a concern with those people whether or not the benefit of that exemption was going to be capped. CGT uplift on deaths retained, fine. The nil rate band frozen at 325,000 again until 2031. I think we probably expected that, but we're seeing the effect of this fiscal drag phenomenon as well with IHT, because it'll be set at that level since I think 2008 now. I know we've had the residence nil rate band in the middle of it, but obviously if you look at what's happened to house prices over the last 25 years, you're getting more and more people being dragged into that IHT net. What has changed? A couple of real kind of minor niche changes around agricultural land held for offshore companies being brought into the scope of IHT, so that kind of mirrors the position with residential property currently. It's going to be a £5 million limit on 10-year charges for former excluded property trusts. Now, initially, there was maybe a little bit of excitement to say, oh, well, actually, does that mean that, you know, we're capping the value that can become relevant property at 5 million? Well, actually, no, it's a limit on the charge. So really, you need to have 85 million pounds of excluded property becoming relevant property for this measure to even affect you. So that's obviously quite niche. Maybe there's a high net worth who's been lobbying the government for that specific change, cutting a deal to stay. But I suppose the main change that we're interested in is the £1 million BPR allowance. I'm sure everyone's sat in seminars over the last 12 months about all these BPR changes and had lots of questions from clients around planning for it. And one of the key focuses about it was that this allowance wasn't transferable between spouses. So that has now kind of been relaxed slightly, common sense measure. It'll basically kind of follow the treatment of the nil rate band and be transferable. So let's just have a quick look at what the position previously was going to be from April 26 and how it looks now. So if we take the example of a married business owner, he holds 100% of the shares. Say the business is worth £4 million. His wife doesn't hold any shares. She dies before him. In this situation, £1 million of the BPR allowance would have been wasted because she died not holding any shares and it wasn't transferable. So the position on his death would be £4 million of shares, less £1 million of BPR allowance, less 50% relief on the excess, and 2 nil rate bands, so his nil rate band and her transferable nil rate band, reducing the chargeable value down to 850,000, resulting in an IHT charge at 40% on 340k. So all the planning that we've been doing or a lot of the planning we've been doing over the last 12 months has been about making sure we use this nil rate band on first death. So we've been saying to people, make sure you equalise shareholdings with your spouse. You know, rely on discretionary will trusts to bank that allowance on first death. You know, they're really nice, flexible structures where the surviving spouse can benefit. You know, you can always rely on deeds of variation as well to bank allowances on first death. For example, if you've equalised the shareholdings between spouses, and on first death, the assets pass under a spousal transfer. Under the, say old rules, the way the rules were intended to first come in, that wouldn't have used your BPR allowance and it would have been wasted basically. But you could have done a deed of variation to redirect those assets on first death to make sure you're using your £1 million. So that was kind of the background to all the things that we've been talking to people over the last 12 months around. Now it is transferable. That previous example looks like this, where we've got £4 million of shares less 2 million of BPR allowance, 50% relief on the excess, 2 nil rate bands, resulting in a chargeable value of 350k. So we've basically reduced our IHT exposure by 200,000, that broadly being 20% of £1 million. So inevitably, people that we've been doing advice for and planning for over the last 12 months will be coming back to us with questions. Have we done the right thing? Has anyone had those kinds of questions yet? No? Okay, so was the planning necessary after all? Have we achieved anything from doing that? Are we in a worse position by having transferred shares between ourselves? And what should we be doing now? So fortunately, the advice generally is it's still a good idea to equalise shareholdings, and what people have been doing still has benefits. And I'll go on to say why that is still the preferred route. So if we take the previous example and we say they've equalised their shareholdings during their lifetime in this example, so they each hold 50% of the shares. Say the trading business is worth 3 million, and you know, if the husband had transferred shares to the wife and she died immediately, BPR would still apply at her death because there's no need for her to survive for 2 years because of successive transfer rules that mean that she inherits her spouse's kind of allowance. So you're not putting anyone in a worse position by doing that. So on the first death, wife dies holding 50% of the shares. She's got a £1 million BPR allowance, 50% BPR on the excess, and nil rate band covering the remainder, reducing her chargeable value to nil. So she's got 75k of unused nil rate band, and this obviously assumes that the shares haven't passed under the spouse exemption on her death. So on the second death, let's say the company's increased to £4 million in value. So it's the same example as previously where the husband died holding 100% of the shares, 4 million, but at the moment he only holds 50% of the shares. So his 50% interest, because his wife isn't around anymore holding shares, there's no kind of related property aggregation for valuation purposes. So his 50% of the shares are just valued in isolation on his death. So he's going to get a 25% discount for that interest. So you're losing 500 grand of value straight away through that discount. He's obviously going to get his BPR allowance and then BPR on the excess over 1 million. And then his nil rate band kicks in as well, reducing the chargeable value down to nil. And then he's got 75k of unused nil rate band. So by doing that and making sure we've used it on the first death, we've benefited from getting the value out of their combined estates earlier, so any growth in value is not accruing in the surviving spouse's estate. And then you're potentially getting the benefits of valuation discounts as well on the second death, because there's not that related property to aggregate. So we're not wasting the BPR allowance on first. In summary, these changes mean that BPR allowance isn't going to be wasted on first death, even if you don't do anything. But it's still a good idea to do something and to equalise the shareholdings. There's a couple of methods for using that BPR allowance on first death. Discretionary will trusts for BPR assets. You can put specific legacies in wills for descendants, for example, children that are going to take over the family business. And then there's also the option of deeds of variation within 2 years of death, if assets have passed under the spouse exemption in the first place. But obviously deeds of variation will rely on the surviving spouse having capacity to actually make that variation. So it's probably a better route to kind of go with that discretionary will trust. So yeah, just at the bottom, benefits of using the BPR allowance on first death is the points that we just discussed: growth in value being outside the estate, and the higher discounts available on the second death. So I'm going to pass you back to Michael now, who's going to take you through to the end and talk about some property changes and corporate tax changes.
Thank you. The first one I wanted to mention was capital allowances. Now, I wanted to mention this because I felt in the budget, and since then we had clients asking us about this, and it came across as if this was being quite a cut in allowances that had been announced. But actually, the take-home message with capital allowances is, in most cases, it's still going to be the same. Most clients, most businesses will still get 100% relief in that first year. On capital expenditure. So if there are concerns when you're speaking to clients, it's actually these changes aren't that major. So what has changed? Well, they've introduced this new 40% first year allowance from January 2026, and they have reduced the writing down allowances from 18% to 14% from April 2026. The new allowance is January 26. So they're what they've introduced. But actually, what you look at what the taxpayers still have, they've still got their £1 million annual investment allowance, and they've still got full expensing relief in that first year. So in most cases, clients are going to still have 100% relief. You might ask what this new allowance is for. What it's been designed to do is it's been introduced so companies so unincorporated businesses that didn't previously qualify for the AIA or full expensing now can qualify for this first year allowance. And also, previously where you had assets that were purchased for leasing, so if you had a leasing company that bought equipment that hired it out, that previously couldn't qualify for reliefs. It will in this instance under this new relief. So it's quite a small point where it's quite a small niche position where you're ever going to claim this relief. But it felt like to me that it was quite a substantial cut in releasing it, and actually it's not. I think this was one of the government's few growth policies that Rachel Reid has been keen to announce, but actually when you look at how it's going to benefit people, it's in very limited circumstances. Likewise, this cut in writing down allowances from 18% to 14%, because we've had quite a few years now of £1 million annual investment allowance and full expensing relief in the last couple of years on any amounts of capital expenditure, most companies, their main pool writing down balances are quite small, or if not nil, because they've had 100% relief in that first year. So in many cases, actually, that reduction in relief isn't going to impact the client's tax position. I just thought it was worth mentioning because it came across as a substantial reduction in capital allowances, and if you've got clients making capital investment decisions, it's probably worth reassuring them that they are still going to get relief in those going forwards. So the next thing I wanted to talk about was landlords. Now, landlords are a group of people that seem to be quite an easy political target to go after. They're not having it easy at the moment, both in terms of tax changes and regulations, which we might talk about in a second. But what's interesting is a lot of these changes only seem to focus on landlords that hold property personally. They don't seem to impact corporate landlords that hold large portfolios. So I'm not quite sure who in the government's coming up with some of these policy changes, but it never seems to be targeted at the right sort of landlords, in my opinion. If you're a landlord that's a landlord by circumstances, say if you've rented out your house because you moved jobs or you moved in with a partner, you're quite impacted by these changes. If you're a big corporate landlord that's got a large portfolio paying corporation tax rates, there's not many changes in terms of tax. So what has changed? Well, as Adam mentioned, we've got this new 2% income tax and rental profits from April 27, income tax frozen to 2023 thresholds. We've got this weird concept of this mortgage interest restriction, which basically means that you can have an economic loss on your rental portfolio, but still end up with a tax charge because you can't have full relief for your interest at your marginal rates of tax. Landlords will also be impacted by this new mansion tax. If they're renting out luxury properties, again, if you've moved house, this is potentially something that's going to impact you. The government's phrased this as a tax on owners and not occupiers, so I think their theory is that it's not going to be passed on in terms of rent payments. Whether that will happen or not, we'll wait and see. Also, there's a lot of speculation about changes to stamp duty, land tax, leading to the budget. There were no changes there, so there's been no benefits there. And also landlords are impacted by regulation changes such as energy efficient upgrades and the Renters' Rights Act that seems to be making things harder for them to operate their businesses. So that's their position. It's quite a glum position. And what I wanted to do is just talk you through an example of how their tax position might look. So we've got an individual here. This is a real life example. He's a higher rate taxpayer and he's got a rental portfolio of about £600,000 worth of properties, £40,000 of rental income a year and £22,000 of mortgage interest costs. An economic profit of £18,000. So his total income is £78,000. This mortgage interest expense, some people comment and say that sounds quite high, but actually when you think about current interest rates at the moment, if you've got a property portfolio of 600k, mortgages of about 60-70% loan to value ratios, that and 5% interest rates, that's quite a typical interest cost. So it's not uncommon for landlords to have half their rental income taken up by mortgage costs. So this next example, it just shows their tax position. So on the left hand side, we've got the position ignoring any rental income. So that's the tax the landlord's paying on his employment income on an annual basis. And this next two columns show the old rules up until April 27, and then the new rules from then. And as you can see, you see the rental income coming here and the mortgage interest restriction that applies at the bottom. But the main thing to see from this is the £18,000 of rental income is resulting in an additional £11,600 of income tax payable on that rent. It's an effective rate of 64%. Under the new rules, the difference is that they're going to get an extra 2% income tax on that profits on the rental income, but also an extra 2% on the mortgage interest restriction. So it's actually an extra 2% on the economic profit. So it's quite a small change. In this example, it's only £260 of additional tax to pay on those rental profits. But in the backdrop of quite high effective tax rates and quite high effective tax rates, it's quite a glum position for landlords to be in at the moment. It's also worth pointing out that these effective tax rates will change depending whether the landlord is an additional rate taxpayer. He's going to pay 5% on £40,000, not just the rental profits. If he's being pushed into over £100,000 and having paid the personal allowance, those tax rates will be significantly higher. Again, with things like childcare relief being lost and things, those tax rates can be significantly high in some instances. So what can landlords do? Well, if you're an individual that's renting out the house for the circumstances you've moved into your partner's house, there's probably not a lot you can do unless you're prepared to pay some tax. If you've got a property business that's renting out a portfolio of properties, it might be time to think about incorporating the business again. An incorporation involves the disposal of the properties from yourself to a company, so you've got to think about capital gains tax, you've got to think about stamp duty. There are ways to claim incorporation relief if you're operating a property business and not just a passive investment company. Depends on the number of properties that you're renting out. Equally, if you're operating through a partnership, then it's possible to claim stamp duty relief on that incorporation. But in many cases, there is a cost to incorporation, so it makes it very difficult to stand here and say incorporating is always the right answer, because the answer is it really depends on the individual circumstances and crunching the numbers. Another idea that I just putting up here, where you're managing the portfolio by yourself, if you're in a circumstance where you don't need all that rental income on an annual basis, you might want to think about charging an annual management fee for your services through a company. It's not going to be a magic answer to getting all the profits out of your personal name, but if you're charging a commercial rate for the management services that you're providing, you might be able to divert 10-15% of your profits out of those high income tax rates and into pay corporation tax. It's something to think about. So a quick example of how this works. Again, so this was the position that we saw before of the income tax position under an individual paying income tax on those rental profits, and then this is a position if we incorporate the portfolio. He loses the rental income on his personal tax return, but he'll pay corporation tax on those profits down there at 19%. Again, an incorporated property company can qualify for that reduced rate of 19% 19% corporation tax. This is obviously the position where that this individual is not extracting any of that income into his personal name on an annual basis. And it does result in a tax saving of £8,500 on an annual basis. On the flip side though, if this individual needs the rental income on an annual basis to supplement his lifestyle, he's going to have to pay dividends out of the company to get access to that cash. So where you've paid corporation tax on your £18,000 of economic profit, you've got dividends available to take out of £14,000, and it actually works out at a much worse position. He's covered the cost of incorporating businesses, and he's paying an extra £1,500 in tax on an annual basis. So the point I wanted to get across is it really does depend on what the individual is currently paying in tax, how much it's going to cost to incorporate, what are the inherent gains. It's a really bespoke piece of advice that you have to look at. I can't stand here and say this is the correct thing to do. So that's the main thing about landlords. It's just something to consider if you've got clients that are now holding portfolios personally. The next one that I wanted to mention was EMI share option schemes. Now, what was announced in the budget was basically a widening of the criteria, of the eligibility criteria to qualify for these schemes. There's various different tax approved share schemes that you can use. EMIs tend to be the most attractive one from a tax perspective, and I'll come on to some of the benefits shortly. But just for anyone that doesn't know, a share option scheme is effectively an option that you grant to your employee. You can acquire shares at a future point in time at a fixed price, which is normally the current value based on the current value of the company. The idea is that you incentivise that employee to help grow the company in the lead up to an exit event, and they benefit from exercising those options and selling it and getting favourable tax treatment in the future. So, what are the changes that have been announced? Well, as you can see here, they've quadrupled the gross asset limit of the company from 30 million to 120 million, and they have doubled the employee count from 250 to £500. They've also increased the maximum number of options, the maximum value of options that a company can give from 3 million to £6 million. So where we've got clients that previously might have reached the limit of options, maybe discounted at EMI because they don't qualify because they've got too many assets or too many employees, these rules might want to be now looked at and say, is this the right thing to do? Should I be looking at an EMI scheme rather than some of the other tax approved or even non-tax approved schemes that you could do? So what are the benefits from here? Well, there's no upfront tax cost of just giving an option to an employee. It's a very easy, cheap incentive mechanism to give them. There's no immediate cost. We can claim advanced assurance from HMRC that a company qualifies for EMI, so you've got that assurance, you've got the security there. You can also agree valuations upfront with HMRC, which is another benefit of these tax approved share schemes. Quite often now, if you're trying to give shares to an employee, there's a risk that you do valuations, but there's no way of getting them pre-approved with HMRC, so you get to a sale event and then the valuation can be looked at. For the employee, they will generally get full capital gains tax treatment on the disposal. So we've not had an equalisation of capital gains tax rates to income tax rates. So this is very attractive for them. They're going to get 24% capital gains tax rate at a maximum. Where they've held the options for 2 years and not the shares, they can also qualify for BADR. Also interesting with EMI schemes, there's no 5% minimum holding requirement. So anyone that holds these share options or acquires shares through an EMI scheme will qualify for BADR, provided they meet the other qualifying criteria. So where in the past we've spoken about the diminishing benefit of BADR because it's been reduced from £10 million limits to the £1 million limits, from 10% tax to 14% to 18%. The benefit from majority shareholders has diminished, but for smaller minority shareholders, it's still quite an attractive tax rate, particularly in comparison to 45% income tax rates. For the company, they get a corporation tax deduction based on the value, the cost of giving those shares to the employee. So, for example, if you've got a company with £1 million, maybe that equates to £10 a share on a pro rata basis. That when you value those shares from a tax perspective, for EMI, you might apply 90% minority discount on that small 1% shareholding. So you might actually be looking at £1 a share as their exercise price. So let's say the company's grown in value from £10 a share to £15 and then they sell it, and the company will get a corporation tax deduction of the cost of providing that share to the employee, which is about £14. So it can be quite a big tax saving for the company. Where this is being exercised immediately prior to a sale, that benefit can also be factored into the sales price for the shareholders. So these are quite an attractive incentive mechanism for both the existing shareholders and employees. They work really well in practice. The final point that I wanted to talk to you about was changes to reconstruction relief. Now this wasn't a point that was announced in the budget, but it was in small print. It wasn't really expected to come out. It was quite out of the blue. And what they have changed is they've tinkered with the wording for the anti-avoidance rules that prevent this relief applying. So this is the relief that's used whenever there's a restructuring, reorganisation, individuals swapping their shares in one company for shares in another company, whether it's inserting the holding company or as part of a transaction. And the relief basically works to say, where I've taken new shares in exchange for my old shares, there's no capital disposal for capital gains tax purposes, and those new shares stand in the shoes of the old shares. So it was a relief that was quite commonly used. Now, what are the changes? Well, previously HMRC had these anti-avoidance rules that meant if they applied, the relief didn't apply, and they could impose a tax charge on the individual. Previously the test, it was a two-part test. First, that the share exchange has to be undertaken for bona fide commercial purposes, and the second part was that the actual whole transaction couldn't have a main purpose of avoiding capital gains tax or CGT. Previously the test wasn't that the share exchange itself had to be done for non-tax avoidance purposes, and this led to some quirky examples where HMRC sort of lost on cases that sort of looked like tax avoidance. So what they are proposing to change the wording to is that the actual share exchange itself can't have a main purpose to reduce or avoid liability to capital gains tax and income tax. They've dropped the bona fide commercial purposes point. And interestingly as well, they've introduced this idea that they can make adjustments to the taxpayer's tax return on a just and reasonable basis. So it's no longer an all or nothing test that the rules apply. They can say, actually, we think this one part of this transaction was tax avoidance, and we're going to counteract that by the tax that you should have paid had that not applied. So, like I said, this was an unexpected change. There was no consultation about why these changes might come in. And when we've thought about it, we've kind of come to two conclusions as to why this has come in. A couple of years ago, there was a case called the Wilkinson case, which effectively seemed like tax avoidance. What happened was that an individual shareholder, owned 100% of the company, he made a gift of, I think it was 30% of the shares to his three daughters shortly prior to a sale, and he sold the company to a purchaser for about £100 million. At the time, those daughters' shares didn't qualify for entrepreneurs' relief. So what they did, rather than receiving cash, they received shares in the new company and also loan notes which claimed this reconstruction relief, and they didn't pay tax up front. In a year's time, when they qualified for entrepreneurs' relief, they then liquidated the loan notes, sold the shares, resigned as directors, qualified for entrepreneurs' relief, and claimed a 10% tax rate on the disposal. So they went from would have been paying 20% to a 10% tax rate. HMRC said, no, that is a tax avoidance. You're not having the share exchange relief rules. They lost because the courts concluded that the main purpose of the transaction was to sell the company, and not that the share exchange itself. Even though the share exchange itself might have been tax motivated, it was still it wasn't caught by the rules. The other reason why the share exchange rules might have changed, about 4 years ago, anyone that applies for clearances will know that clearances became very hard to get, and HMRC was saying it's not for commercial reasons. You could just pay dividends to shareholders rather than trying to ring-fence cash in a holding company, and they were not being very helpful. Now, this coincided with a senior leader in the clearances team retiring, and their clearances team relocating from London to Birmingham. I believe no one wanted to relocate up to Birmingham from London. I'm not sure why. I hope no one's from Birmingham in the room. But yeah, so they ended up with an entire new team. They were looking at these clearances, and that was sort of said to be a big part of why the clearances became more challenging to get. There wasn't a change in policy. Now, whether these new rules are actually because they don't want to give those kind of clearances going forwards, we'll have to wait and see. But it might mean that clearances become a little bit more challenging on straightforward things in the future. For clearances that have already been submitted or in the process of we're waiting for response from HMRC, so the new draft legislation will apply for clearances that were submitted on or after 26th of November 2025. If you've got clearances submitted prior to that date, you will be operating under the old rules. Then you have until January 2026, or 60 days from the day you get the clearance received, to complete that transaction. So there is now going to be a bit of a time pressure to get some clearances, get some transactions completed under those old rules. You might have to think about resubmitting clearances if you've got transactions, particularly if they're a little bit spicy or interesting. Then you might have to think about reapplying for clearance under those new rules, or making sure that it's done before the deadlines. So it's a small point, but it will have some reasonable significant impact how restructuring is done going forwards. So in summary, taxes have gone up across the board, and things are becoming more complicated. I think it was a couple of years ago, Kwasi Kwarteng scrapped the Department for Tax Simplification. Whether we're starting to see the ramifications of that, I'm not quite sure, but certainly, we're getting more tax rates, we're getting different, it's becoming more complicated. Another interesting point, a lot of these measures that we've spoken about today come in from 2027 onwards. Can't quite see the rationale behind that. You'd think that they'd want to do the paying early on and then make things easier before the next election, but I suppose they're trying not to break the manifesto promises. They're just asking people to contribute more. But yeah, so things are coming in later. We have got a bit of time to plan. But again, the key take-home message, and I think this has been the sort of message for the last couple of years in tax, is because it's becoming harder and harder to undertake tax planning once you've got value, it's becoming more and more important to plan early and make sure you structure your affairs correctly from the outset. So it's just going forward, that's what we're going to think about a bit more. So that's it from me. Any questions on what we spoke about? No?
We'll be sticking around for sort of 10 or 15 minutes afterwards if anyone wants to come and have a chat.
Yeah, thank you very much.